Hey everyone, welcome to the last video in the M&A transaction series. In this video, we're going to be talking about due diligence and why it's so important. So this is a fairly short video to cap off the series compared to some of the other videos. So primarily, in the previous videos, we've talked about kind of why it's so important to do due diligence, why due diligence is worth its weight in gold. And that's a big statement because due diligence can be quite expensive. You can easily spend $200K per advisor on a transaction, even for a relatively small acquisition, because the same level of work still needs to be done. Granted, it does scale up from there. So you can spend $200K on financial due diligence, another $150K on tax due diligence, maybe another $150 to $200K on commercial due diligence. And then on top of that, you've got to pay your legal fees as well, both for your legal due diligence as well as your sale agreement, SPNA drafting. So there's a lot of money. You can spend between $500 and $1 million on some transactions, and they don't even have to be that big of a transaction. So it's a lot of money. So why is it so important? So just to quickly recap some of the earlier videos as to why it's so important. Well, we know based on the purchase price calculation about how each of these kind of elements impacts the purchase price. So EBITDA, is a multiple of that impacts your headline purchase price. So essentially every dollar of EBITDA that your advisors can essentially save you from the buyer's perspective, or conversely on the seller side, if you've got sell-side advisors, investment banks, etc., who can add an extra dollar of EBITDA, to the final, agreed terms, is going to give you a multiple of that. So if the multiple is 10 times EBITDA, you get an extra $10 of that, right? So, even if your advisors can save you an extra $100,000 in EBITDA just by being on board, times that by 10, you're talking about $1 million difference to the purchase price. So that very quickly adds up. On top of that, you've got your completion adjustment. So we know from the previous videos that $1 of net debt and cash, sorry, I'll just go full screen. We know that $1 of net debt and cash adjusts to the purchase price 1-to-1. Essentially, any extra dollar of net debt that you can add on here adds an extra dollar to the purchase price, or vice versa, depending on how you go. So again, if you have even better advisors who can, for example, if you're a buyer and you've got really high quality financial duty, if they can dig around the accounts and find an extra, say, $1 million in net debt items and argue that, well, this should be included, or maybe it's something that's contingent that's off the balance sheet that should be included as well. Maybe your lawyers found that. Or maybe on the seller side, for example, you could argue that certain items of cash that may appear like trapped cash should be part of the cash and therefore increase the purchase price adjustment, right? So it's, if they can find $1 million of savings in net debt or cash on either side of the equation, right, they've got another $1 million to the purchase price, right? And then you can see how this can very quickly pay back the advisor fees and then quickly add value beyond that as well. And that's even before, general approach, speediness, clauses on, CapEx and commitments and liabilities, etc. So the value really starts to add up. They could also kind of help you potentially if you've got able to negotiate a better comps analysis by using, advisors who are able to argue a certain point, which you might not be able to do by yourself. For example, they might say, when you do your comps analysis, this company should be included, it's too high. And if you take that out, these are the comparable ones, it's actually a lower or a higher multiple, and therefore save you some money on that through the purchase price as well. They could argue with different kind of methodology for using. Someone might be using, they might be arguing your company should be using EV over sales instead of EV over EBITDA, which results in a better overall purchase price. So just quickly going through, so that's why it was really important to just have really good advisors, because at the end of the day, it might not seem like it might seem a cost, but at the end of the day, if you have good advisors, they're really a value add to the process. So let's just quickly skip ahead now. Sorry, I just wanted to revisit some of the older slides and recap on some of the lessons that we've learnt from the earlier videos. They can also help you navigate the sale and purchase agreement to avoid any issues down the track as well. So in terms of the actual process timeline, when do the kind of advisors come in? When do they potentially help? So even before you've kind of put together a deal, even before you've kind of signed heads of agreement, before you've done DD, before you sign the deal. Advisors are going to be adding value from very early stages. And a good example of that is CDD. And you might be just looking at an industry that you potentially want to invest in. CDD is essentially your commercial due diligence, and that's done by people like, your management consulting companies like your Bain, your BCG, and even there's some mid-tier options. So a good one that I recommend is Strategy N from PwC, because if you've ever gotten quotes from BCG and Bain, they ask for a ridiculous amount of money. Strategy N does maybe not as high quality work, but it's not that different, and the price is significantly cheaper. So in the US or European markets, I might also recommend using some of the more boutique players rather than those big four consultants, because they're just ridiculously expensive. But what they do is essentially they're consultants. They look at the market. You might say, I want to go into the veterinary industry. So what they'll do is they'll look at what's the historical growth rates of the industry, what are the forecast growth rates of the industry. They'll speak to experts. They'll form a view as to kind of what are the risks, what are the tailwinds of the industry. They'll help segment it down into the different drivers, into volume, into price, and then do another level down. Say, okay, well, number of households and the number of pets per household, and then so essentially they'll look at the drivers of the industry and help you determine whether this is an investment that you even really want to get into, at least from the buy side. From the sell side, they might also help do the same thing, but put together what's called vendor due diligence, which is essentially a pack prepared by the sell side, which kind of helps mitigate the need on the buy side to do the same analysis, and they can also help kind of frame the messaging a little bit to be a bit more positive. So that's when CDD comes in. They'll help you understand the industry, the opportunities, the risks, any possible synergies, any possible kind of cost savings. They'll, as I mentioned before, they'll speak to a number of kind of experts in the industry, whether that's employees, business owners, CEOs of industry leaders. They'll also help you to kind of form a view of the market. They'll also help do a competition analysis. So it'll help you understand who are the key players, what's their market share, how has that changed over time. If you're looking for acquisition opportunities, they might help you kind of segment the market into possible bolt-on acquisitions or mergers, or even segmenting, the number of independents in that market. So, that's not a conclusive list of what they do, but hopefully it just gives you a little bit of flavor as to what the management consultants will do and where the value is. That service is a little bit expensive, but I can say, I would much rather spend $200K on analysis, realize the risks of a particular industry and not invest, rather than invest in an industry, spend $50 million on a transaction or $100 million, and then figure out there's huge amounts of risks and then be stuck with a dodgy asset that I can't sell. Definitely better to pay the due diligent advisor fees up front. Definitely worth it. You might be familiar with the expression, don't be penny smart, dollar dumb, and this is a perfect example of that. So you're spending $200K, and people might want to save money on it, but at the end of the day, the real money that we're talking about, which is your investment, we want to be smart on that, not the small dollars. So next step in pre-diligence is when you're actually structuring the proposal, and this might be drafting, high-level terms, might be heads of agreement, might be talking about kind of, how do we define EBITDA, what the multiple we're paying, what items are included in net debt, how are we structuring the deal, is there an earn-out, is there an equity component, is it all cash, what's the vendor component, like determining the JV percentage, any other kind of qualitative terms, and explaining why you're the preferred buyer. So typically you might not engage advisors at this point unless you're not really in the business of doing this. For example, you're a strategic/trade buyer who's just looking for a bolt-on acquisition. You don't typically do acquisitions. You might engage like a tax or investment banking advisor to help you with this step. Next step is commercial consideration. So this is when you might do a bit more of a deep dive with the commercial due diligence guys, and typically it's in two phases. One is a little bit of a high level kind of analysis, and that's kind of identifying the high level risk. And then once you're actually ready to go a little bit further, you do the deep dive CDD, which is kind of all the items that I was talking about before with the market analysis, the competitor analysis, the interviews, etc. That's mostly going to go into that kind of second stage down here. Next is, the deal's progressing. We're now kind of getting through the main diligence period. And typically, we're only going to get to this period once, we've received a certain level of exclusivity in the heads of agreements, and maybe we're the only party remaining in the due diligence period. Otherwise, why would we be committing all this capital, this cost to advisors? So we might be looking at assessing trading and cash flows. So this is your core financial and tax due diligence. So for financial, you might want to appoint, a Big Four accounting firm, your KPMG, your PwC, your EY, or your or your Deloitte. And for your tax due diligence, you might just use the same company, or you could use a different one. I'd probably use the same company just because there probably is some synergies with the financial due diligence team and the tax due diligence team. They'll typically work together. They might include it in the same deck. Tax due diligence is a very important one, so don't skip out on this, because if there are any tax liabilities, you can include this as a net debt adjustment item, and you really want to be aware of any tax issues because it can be quite a substantial amount in dollar terms. So typically it's going to be in 3 phases, which is number 1, key issues, which is just basically your red flags report. So your financial and tax due diligence, they'll say, okay, you don't need to read the full report, but these are the key issues we've found. For example, we find maybe they've been underpaying their employees. Maybe we think, the accounting policy on revenue might be understating what the true recurring underlying revenue we think should be going forward. Maybe we've identified a couple of stamp duty issues, right? So that's just a couple of examples what you might see in a key issues or red flags report. Next is remaining field work. So I'll typically give you an update throughout this process and then do maybe a deeper dive. And that also gives you an opportunity based on that initial key issues, red flags report to maybe hone into a couple of issues and do a bit more work in those particular issues rather than just doing a generic across the board DD. And then they might report again, give you an update throughout that process and maybe do another refining, do a deep dive on a couple of areas. And then the final phase is essentially just closing off the report, and that's providing a full financial due diligence and tax due diligence report, which is typically a PDF report prepared in PowerPoint, which might be 50 to 100 pages long. And at each stage you've got agreed outputs. There's key issues hit early, and negotiation value issues are prioritized because ultimately that's what the buyer and seller care about. Now, in terms of that first point, the agreed outputs in each stage, I didn't touch on this earlier, but it's applicable for all kind of appointment of advisors, regardless of CDD, tax, commercial, legal, whatever it is. All of these, before you engage them, what you typically do is you agree a mutual scope, and the advisor will typically rely on you to provide that initially. Based on kind of what you think the key focus areas. And if you're not really sure about what that looks like, you can just say to them, look, can you just give me a fairly generic one and I'll edit that. And that's typically what they'll do. They'll give you a standard list based on what they think it is. You will then go through it and review it and say, okay, based on my knowledge of the company, I kind of want to look at this, or this is what I'm particularly worried about. So let's do a bit more area on, say, wages and salaries, for example, because it's a lot of competitive pressure in that particular area of the business. So it's kind of a refinement process. You then give it back, and that helps kind of determine what the advisors will look at in particular. Okay, so the next step is completion, structuring, and SP&A support. So this is helping you, okay, so how do you actually structure the deal? How do you actually draft the sale and purchase agreement? That includes kind of what terms you're going to include, and these are all the key issues we came across before, including kind of definitions, deal structure, warranties and indemnities, material adverse clause, wording of, your upfront, your completion mechanisms, your net debt, like including what items are included, what items aren't. So you might have advice from your tax DD in terms of any particular issues you particularly want to focus on in terms of, including a net debt or potentially mentioning in the warranties and indemnities. You might have specific accounting accounting warranties and indemnities based on some of the findings from the accounting and financial due diligence. And you might even have, if you have an investment banking or other kind of, sell side advisor, they might advise you on the completion mechanisms and wording around that as well. So the next step of the main due diligence period is essentially, and this is after you've signed the SP&A, is essentially preparing for post-deal action. And this is when you're starting to focus more on that kind of big picture strategic side. So less to do with the numbers and in the detail and more big picture. So what are we going to do in our first 100 days? If there are any kind of synergies identified and factored into the purchase price, how are we going to achieve them? How are we going to integrate the teams? How are we going to make sure that there's no kind of turnover and resignations and that the culture stays the same? How do we make sure that the growth that we're forecasting in our DCF analysis is going to be hit, and what kind of actions and implementation plans do we need to implement to reach that? Are there any cost cuttings required that we've kind of flagged earlier on? So, who's going to lead the company? Do we need to fire anyone because there's 2 CEOs or 2 CFOs or 2 COOs? Right? So it's thinking about that stuff, putting together an integration plan. Now, there are advisors who do this. I know kind of the Big Four accounting does this. I know that, the management consultings do this. I don't think there's any one firm who's particularly good at it. I don't think professional advisors in general are that great at integration plans. I think ultimately the company buying it should be the one doing this, because at the end of the day, there needs to be a strategic reason why you are buying this company, and ultimately you can't have an advisor tell you what that is. You need to have a reason for it, you need to have a plan for it, and ultimately you need to take responsibility for the acquisition. I think it's very common for companies to just say, I want to do an acquisition, and then hand off all responsibility to the advisors. But at the end of the day, the advisor is going to step off the deal at some point, typically around completion, and at the end of the day, you will be held responsible for the growth. And I think a lot of acquisitions don't perform post-acquisition because of that reason. So this integration step is probably one of the most important points out of all of these, just having a really good integration plan. And I guess this is also coming back to that very first video that we talked about in terms of M&A strategy, which I'll quickly flick to, why are we doing the deal in the first place, and it's ultimately it needs to be one of these reasons, right? So is it improving the target company's performance because we think we can do better and we know there's inefficiencies there? Is it because there's consolidation to remove excess capacity from the industry? Do we need to close plants as a result of that? Do we need to fire people and restructure the business? The third strategy was accelerate market access for the target or buyer's products. So if we're using our kind of target companies, I should say it the other way around. If the target company plans to use the acquirer company's infrastructure, what's the integration plan for making that happening, for onboarding it, for education? Do we need to hire additional staff to make that happen? Do we need to make an investment in marketing or distribution costs, and do we have a budget for that? So those kind of questions. Next is get skills or technologies faster or at a lower cost than can be built. So if we're a tech company and we're just acquiring this company for either a particular software they've built or the staff they've built, how do we integrate that with our main site? How do we test that? How do we get that working as soon as possible? For the new staff, how do we make sure that they're actually retained in the business and not just staying there for a year or 2 years' time to get their payout? How do we make sure that they stay there long term? Number 5, exploit a business's industry-specific scalability, right? So how do we quickly scale the business? What are the steps we need to take to achieve that? And then finally, pick winners early and help them develop their business. All right, so how do we accelerate that growth? How do we drive that culture? What can we do to help that company? And what's our reporting process to make sure, over time that we are checking back and actually seeing if this company is growing as we thought it would over the long term? So, these are all the kind of the reasons why we need to acquire. But in terms of that integration plan, there's no correct or one way of doing things, right? Ultimately, at the end of the day, it's really dependent on the company you're acquiring, what you want to do, what your strategy is. So it's a difficult one. It's kind of like working capital in that there's no set definition for it necessarily. But it's also the main area that most people don't really understand that well. So if any of these I can ask you to try and do really well, it'll be this one here. So next step in terms of kind of advisor involvement is around completion accounts. So you might get your, so the reason is, because the buyer now owns this company and they have to compare these completion accounts, both parties are kind of worried about how accurate the information is. So a common approach is to actually get the same party who did the financial due diligence to do the completion accounts, because they're already familiar with the business and they're also an independent third party. So hopefully they're providing an unbiased perspective. which makes the whole process a little bit more transparent. So they're going to actually prepare the balance sheet and do the calculations as per the SP&A definitions. And then finally is post-completion. So this might be a year or 2 years or 3 years down the track, or every year thereafter, is essentially a follow-up review. And this is the step that I think a lot of companies also really miss. They do the acquisition, they kind of leave it, but they don't go back and revisit their initial assumptions and revisit their initial risks and just do a checkup and see how everything held up in retrospect. And also checking out the integration and kind of seeing where we're at with that as well. So there's probably not as many advisor teams with this. It's probably more of an internal process, and I think that's why maybe it's missed a lot. But there are definitely professional advisors who can help with this. Probably the teams that I would involve is maybe the original advisors, just because they are familiar with the deal, with the logic, with the due diligence, etc. It's worth spending the money on, at least, or doing it internally. Okay, so now let's talk about the importance of due diligence, which is, I think I've emphasized this message quite a few times already. In terms of, it's don't be penny wise, dollar dumb. We want to be smart with our dollars, the big dollar investments, not the small dollar investments. And advisor fees are the small dollar investments relative to the acquisition cost. So the context is transactions in Australia are conducted on a buyer beware basis, where the onus is on the buyer to understand the assets and liabilities to be acquired and the future cash funding requirements of the business. Consequently, undertaking due diligence is an integral and standard procedure in this transaction environment in Australia. So the following examples set out key risks and examples of not undertaking due diligence prior to acquiring a target. So the first area is integrity of underlying financial information. So the key due diligence requirement is understanding and evaluating management's accounting policies and the impact these have on the financial information. So the risk of not undertaking due diligence on this area is that under accounting standards, a number of areas of accounting subjectivity exist, and the measurement, recognition, and disclosure of financial information is often subject to management discretion, for example, revenue recognition, provisions, etc. So failure to adequately understand the basis of preparation of financial information may result in overstated financial results or understated future funding obligations being included in your valuation model. So an example of this is, as a result of engaging Big Four to undertake due diligence in relation to a pension provision obligation, a confidential Big Four company identified an additional $10 million of pension obligations that were not recognized in the financial information provided by the target. This would not have been identified had due diligence not been undertaken, and resulted in an equal $10 million reduction to the final purchase price. Next area of due diligence is forecast trading performance. So typically when you're doing due diligence, the seller will provide the actual historics, and they'll also provide a forecast as well. So understanding forecast trading performance, including analysis of management's assumptions with reference to historical performance, market conditions, contractual arrangements, and key risks and opportunities. So the risk of not undertaking due diligence on the forecast is that forecast financial information, it forms part of your valuation model, which then determines your the range that you'll pay for this business, and it may result in you materially overpaying for the asset. So an example, a confidential company based their valuation model on management's forecast without undertaking appropriate due diligence. Post-acquisition, it became evident the management's forecasts were highly aggressive and unachievable, and consequently the company had materially overpaid for the assets acquired. And this is very common. Obviously the sellers they're going to be more positive, either intentionally or unintentionally. They're still going to be probably more positive than they should be. So try and err on the side of conservatism. Next area is working capital trends. So a key due diligence requirement is just analyzing year-end and monthly working capital trends, focusing on potential completion issues and future funding requirements. So the risk of not undertaking due diligence is not understanding the current and future working capital requirements can result in material additional cash funding requirements post-acquisition. So as an example of this, so not understanding the seasonal and intra-month working capital requirements resulted in a company having insufficient cash available post-acquisition to manage their working capital commitments, and consequently a material further cash injection was required post-acquisition for the company to continue trading. So another area of due diligence is capital expenditure. So a key due diligence requirement is considering historical and forecast CapEx requirements, including new site CapEx, IT, and other CapEx. So the risk of not undertaking due diligence here is not understanding the current and future capital expenditure requirements can result in material additional cash funding requirements post-acquisition. So an example of this is failure to undertake due diligence and understand the full extent of the capital expenditures requirement needed to complete construction of a new packaging facility, resulted in material additional CapEx funding being required by a confidential company post-acquisition, which they had not included in their valuation price. Next area of due diligence is contingencies and commitments. So understanding the target's financial commitments and contingent liabilities, including management's basis for these estimates. So the risk of not undertaking due diligence here is not understanding the target's future commitments and contingencies may result in material additional cash funding requirements post-acquisition. So an example of this is a company that did not undertake due diligence and consider the target's contingent liabilities pre-acquisition was required to pay a material legal liability that became payable following completion of litigation procedures post-acquisition. So as I've mentioned before, look, yes, you could potentially claim this under warranty indemnity clauses in the agreement, but I mean, there's a number of reasons why that might not occur. Number one, the dollar amount might not be high enough to claim. It does need to be above a certain amount in the sale agreement to actually proceed, and also to be worthwhile, the company's time. Number two, there still might be a joint venture arrangement with the other party. So, you'd have to sue the company that you're still working with, and that can really sour relationships. And number three is, you might lose the case and it might actually go against you, and then you've got to pay legal costs on top of that. And number four, finally, the costs actually need to be recoverable, right? What happens if the company that you're suing, aka the seller, has gone bankrupt, has closed down, has moved away, and you can't contact them, etc., right? So yes, it's possible, but don't assume that it is. And then finally, tax due diligence. So why is this a key due diligence requirement? Because, first of all, what is the requirement? So considering income tax and indirect tax to ensure tax provisions are appropriate, identify unusual or contentious items, and understand any ongoing disputes or open issues, analyze the tax consolidation calculations and the tax carrying value of assets. So I think that tax due diligence is often overlooked and sometimes even skipped as part of due diligence. And in part, I think people, because they don't fully understand the tax ramifications, they think, tax system, I'll just give it to the tax accountants. They'll get it. They'll do the due diligence. It's fine. But I think it's really, really, really important that you have a very, very strong groundwork in tax, because once you do, you realize, wow, this is a lot of money that we're talking about, or a lot of potential exposure. I mean, even just thinking about it logically, if your tax rate for companies is 30%, right, that's 30% of EBITDA that we're talking about for 1 year. What happens if they haven't lodged a tax return for 3 years? That's 30% of your EBITDA times 3. It's essentially all of your EBITDA value as a potential liability. And that's just one, that's a low risk thing, but that's just one thing. The tax system is so complex. There's so many different areas, from FBT, from Div 7A, from shareholder loans, from, transfer pricing, capital gains, right? Like there's hundreds and hundreds of potential risk areas. And I think once you go through some of the tax videos, which is, later in this course, I think it's really important that you do watch those videos and understand it, because it's going to help you understand the importance, help you understand the potential risk. And I think the risk is high because the seller company often will also not fully understand all of their tax obligations. It's a complicated tax system, regardless of where you are in the world. And somewhere they may have missed some sort of tax issue, or so I think it is really important to do that, the tax analysis. So the risk of not undertaking tax due diligence is not understanding the tax position of the entities to be acquired may result in additional tax obligations or commitments being payable post-acquisition. So an example of this is by not undertaking tax due diligence, a confidential company did not understand the full extent of historical tax liabilities in an overseas subsidiary of an entity acquired, which resulted in material tax payment having to be paid by the acquirer post-acquisition. Okay, so that's the end of the due diligence video. As I mentioned, fairly short and sweet, but I guess the key message here is don't skimp out on professional advisors. Understand where they can add value in the process and invest in them, because you will get your money back through your investment in them. and don't be penny smart, dollar dumb. So that's really the key takeaway. Hopefully you found this useful, and thank you for watching the M&A series.